Listen, I want you to picture something real. It is a Tuesday morning in late January 2026, somewhere outside Sarasota, Florida, in a paid-off three-bedroom on a cul-de-sac where the mailboxes still have the original 1987 brass numbers. Linda is 68 years old. Her husband Robert, 71, a retired regional operations manager for a company that made hospital bedding for 40 years, died 19 days ago. Cardiac event. He was at the kitchen table reading the Sunday paper, and then he was on the kitchen floor, and then he was gone. And Linda has spent those 19 days the way every new widow spends them, which is to say in a fog where the coffee gets cold 3 times before she drinks it, and the dog keeps walking to the back door and looking for Robert, and Linda keeps almost calling Robert's cell phone to ask him where the spare furnace filters are kept. The casseroles have stopped coming. The phone calls from the church have slowed. The flowers on the front porch have been thrown away because they were attracting bees. The 2 kids, Michael in Charlotte and Sarah in Denver, flew back home for their lives, and now the house is quiet in a way that Linda has not heard since 1976, when she lived in a studio apartment off Bee Ridge Road, with a beanbag chair and a black and white television. And on this Tuesday morning, Linda is sitting at that same kitchen table where Robert died, and she has opened a manila folder marked, in Robert's handwriting, the handwriting of an engineer who learned penmanship from Catholic nuns in 1958. The words House, IRS, Insurance, and inside that folder Linda is finding a paper trail that she does not understand. She is finding 401k statements with her name on them as primary beneficiary, which is good. She is finding a Vanguard IRA, $612,000, with a beneficiary line that just says, in pen, review. She is finding a Northwestern Mutual Life Insurance policy, where the beneficiary is, and you are not going to believe this, Robert's mother, who died in 2003. She is finding a deed to the house, paid off in 2012, that lists Robert and Linda as joint tenants, which sounds protective until you find out what it actually means in front of an estate court. And she is finding zero, none, not a single sheet of paper, related to a trust, a transfer on death deed, a portability election, a durable power of attorney that survived Robert's death, or an updated will. The will she finds is dated 1994. Bill Clinton was president. Linda's hair was brown. There is no Form 706 on file. There is no DSU election. There is no spousal rollover instruction on the IRA. There is no transfer on death deed in the Sarasota County Recorder's Office. There is no successor trustee named because there is no trust. And here's the part Linda does not yet know. Linda does not yet know that the system has been waiting for this exact paperwork to be missing. Linda does not yet know that she has about 15 months, give or take, to file documents that her husband should have filed years ago. And if she does not file them, Michael and Sarah are going to lose somewhere between $180,000 and $600,000 of what Robert and Linda spent 45 years building. Linda does not know that the IRS is patient. The IRS is waiting. The IRS has built the trap, and it is closing slowly, like a steel door on a hydraulic hinge, while she searches the manila folder for the furnace filter receipt. That is the situation I want to talk to you about today. Because if you are watching this and you are over 60 and your spouse is still alive, you are sitting on a window that is closing faster than you think. There are 5 specific forms that need to be filed, or signed, or recorded, or updated, before your spouse passes. And if they are not, your children will lose the house. Not all of it, just enough of it that they will remember. Before I walk you through those 5 forms, one ask. The algorithm in 2026 has a documented suppression problem on senior financial content. The platforms do not want this video reaching the people who need it. There is a research paper from a center at a state university that documented this in October, and there are committee discussions in at least 2 state legislatures about senior content reach. And I am not going to bore you with the citations, because you did not come here for a footnote. You came here because something has been gnawing at you. So if anything I am about to say lands in your gut, smash the like button. I know that sounds like every other YouTuber on the planet. The difference is that on this channel, every single like pushes this video to roughly 40 more retired households in the next 24 hours. And one of those households contains a widow like Linda, who has the manila folder open on the kitchen table right now. So you are not liking a video. You are pushing a survival guide to one more family. hit subscribe, hit the bell. The suits in the legal department want me to remind you that I am not your attorney. I am not your CPA. This is not financial advice. This is a survival guide for what happens between the death of one spouse and the arrival of the IRS notice. Let me tell you what actually happened mathematically, word by word, so you understand the size of the crime. Here's the dirty little secret that the estate planning industry has been hiding for 40 years. The American Tax Code, the Internal Revenue Code, and the 50 state probate statutes are designed around one assumption. The assumption is that the first spouse dies with all the right paperwork already filed, all the right beneficiary lines already updated, all the right deed instruments already recorded, and the surviving spouse is operating from a position of legal preparedness. The system was not designed for grief. The system was designed for paperwork, and when those two things meet, grief loses. Every time. There are 3 layers to this trap. I am going to walk you through each one. Pay attention. Layer 1 is the step-up and basis trap, and it lives inside IRC Section 1014. When your spouse dies, the assets that pass to you, including the house, get something called a step-up in basis. That sounds technical, so let me make it concrete. You and your spouse bought the house in 1984 for $68,000. It is worth $440,000 today. That is a built-in capital gain of $372,000. If your spouse dies and the house is titled correctly, that built-in gain gets, in the language of the code, stepped up to the date of death value. The $372,000 of gain vanishes for tax purposes. If you sell the house 6 months later for $445,000, your taxable gain is $5,000. Not $377,000. $5,000. Now here's the dirty trick. The step-up only fully applies to assets that are correctly titled and correctly documented at the moment of death. In a non-community property state, joint tenancy with right of survivorship only gives you a step-up on half the property. Half. So in Linda's case in Florida, which is not a community property state, when Robert dies, Linda gets a step-up on the half that Robert owned. She does not get a step-up on the half she already owned. Which means that when Linda eventually sells the house, or when Michael and Sarah inherit it and sell it, there is a built-in taxable gain on the half that was never stepped up. On a $440,000 house with a $68,000 original basis, that is a $186,000 phantom gain that the IRS gets to tax at long-term capital gain rates, plus the 3.8% net investment income tax if the kids are over a certain income threshold, plus state capital gain tax in states that have it. The total bite can be in the upper teens to the upper 20s percentage-wise. We are talking about $35,000 to $55,000 of tax on the sale of a house that should have transferred tax-free. That is layer 1. Layer 2 is the IRA distribution trap, and it lives in 2 places. First, the spousal rollover rules under IRC Section 408D3. Second, the Secure Act of 2019, which Congress passed in December of 2019, and then doubled down on with Secure 2.0 in December of 2022. Here is what nobody told you when you opened that IRA in 1991. When your spouse dies, you, as the surviving spouse, have the right to roll the IRA into your own name. Treat it as your own. Continue the deferral. That is the spousal rollover, and it is the most valuable estate planning move available to a widow or widower in this country. But, and this is the part the brokerage firm will not volunteer at the kitchen table, that election has to be made affirmatively. It has to be documented. And if the beneficiary line on the IRA says, like Robert said, review, or if it lists the original beneficiary from 1991 who happens to be the spouse's father, who has been dead since the Clinton administration, the IRA does not flow cleanly. It can flow through the estate, and if it flows through the estate, you lose the spousal rollover. You lose the ability to defer. And under Secure Act rules, the IRA has to be fully distributed within 5 years if it goes through the estate, or within 10 years if it goes to a non-spouse beneficiary who is not an eligible designated beneficiary, which is a category your adult children do not qualify for unless they are disabled or chronically ill. So a $600,000 traditional IRA, which is all pre-tax money, gets distributed to Michael and Sarah over 10 years. Each year, they have to take a chunk. That chunk lands on top of their existing W-2 income. Michael is a vice president at a regional bank in Charlotte, making $185,000 a year. His marginal federal rate is 24% now, but a $60,000 forced annual distribution on top of his salary pushes a portion of his income into the 32% bracket, plus North Carolina state tax. Sarah is a nurse anesthetist in Denver, pulling north of $200,000. She's already in the 32% bracket. The forced distributions push her into 35% on the margin. Run the math. Over 10 years, the kids will pay roughly 28 to 33% of that $600,000 IRA in combined federal and state taxes. That is somewhere in the range of $170,000 to $200,000 of tax. Money that should have stayed deferred and grown, gone to the IRS instead. Because Robert never updated the beneficiary line in 1996 when he meant to, and never updated it in 2005 when he meant to, and never updated it in 2018 when the Secure Act was being written, and his Vanguard rep sent him a generic letter that he stuck in the manila folder under IRAS. That is Layer 2. Layer 3 is the probate and deed trap, and it varies by state, which is why the rule of 3 matters, and we will get there. But the bones of it are this. If the house is in joint names and your spouse dies, the house transfers to you outside of probate. That is fine in the moment. But when you die, the second spouse, the house goes through probate. Probate is a public, court-supervised, attorney fee generating, creditor notification issuing, asset distribution process that can take anywhere from 6 months to 2.5 years, depending on the state and the complexity of the estate, and the fees can run somewhere between 3 and 7% of the gross estate value. On a $440,000 house, plus $612,000 IRA, plus $200,000 in other accounts, you are looking at a gross estate north of $1.2 million. 3 to 7% is somewhere between $36,000 and $84,000 of fees that come out before Michael and Sarah see a dime. And here's the part that really stings. Probate is public. Anyone can walk into the Sarasota County Clerk's office and pull the file and see what Linda owned, who got what, and how much. The creditors get notified by law. Old credit card companies that nobody knew about. Old medical bills from a hospital stay in 2011. A contractor who claims Robert owed him $4,200 for a roof repair in 2008. They all get to come out of the woodwork and file claims against the estate during the probate window, and a lot of them get paid because the executor does not have the energy or the budget to fight them. That is the trap. 3 layers. Step-up basis loss. IRA forced distribution. Probate exposure plus public disclosure plus creditor claims. Stacked together, on a normal middle-class estate of $1.2 million, the total leakage can run from $200,000 on a clean and lucky outcome to $600,000 on a messy one. That is not estate tax. That is friction. That is the cost of paperwork that was never filed. So who built this? Who designed this? Let me name the villain. The trap was not designed by a single person. It was designed by Congress. Over the span of 7 major pieces of legislation, going back to the Tax Reform Act of 1976. The Joint Committee on Taxation, which is the bipartisan committee that scores tax legislation for the House and Senate, has known about every one of these traps for 40 years. They have written working papers about it. They have published revenue estimates that explicitly account for the additional revenue generated by estates that fail to file. Form 706, fail to make the portability election, fail to update beneficiary designations, and fail to record transfer on death deeds. That is real. The federal government scores the revenue from your paperwork mistakes and bakes it into the budget. The 2 big ones to remember are the Omnibus Budget Reconciliation Act of 1993, which tightened the Medicaid look-back and estate recovery rules and forced states to chase your house after you die if Medicaid paid for nursing home care. And the Secure Act of 2019, which killed the stretch IRA for non-spouse beneficiaries and replaced it with the 10-year rule. Secure 2.0 in 2022 made it worse for adult children inheriting traditional IRAs. Then in the summer of 2025, Congress passed the legislation people are calling the One Big Beautiful Bill, which made certain TCJA provisions permanent and raise the federal estate tax exemption to $15 million per individual starting in tax year 2026. That part sounds like a win, and for very wealthy estates, it is. But here is what the headline did not tell you. The Joint Committee on Taxation scored the bill explicitly assuming that most middle-class estates would not file Form 706 at all, because they are below the exemption, and therefore would lose the portability election by default. The bill did not extend the deadline for filing Form 706 to claim portability. It is still due 9 months after the date of death, with a 6-month extension available, and the IRS has a special simplified procedure if you file within 5 years, but most surviving spouses never hear about any of those deadlines. This is not an accident. This is not bad luck. This is the tax code working exactly the way it was written. The default settings of the American estate system are calibrated for maximum government revenue and minimum family preservation. The friendly commercials with the silver-haired couple kayaking through a sunlit lake while a voice tells you to plan for tomorrow are not designed to make you actually plan. They are designed to sell you variable annuities. The guy in the navy blazer who sold you the index product in 2014 and bought you a $4 coffee twice a year while calling it an annual review never told you about Form 706, because Form 706 does not pay him a commission. Pause the video. I want you to do one thing. Open the comments. Drop your field report. Tell me 3 things: your state, your approximate age, and whether your spouse has updated beneficiary designations on every retirement account in the last 5 years. Just yes or no. You do not have to share dollar amounts. You do not have to tell me the names of your accounts. Just state age, beneficiary status. The comment section on this channel is the field hospital. I read every single one. And the reason I am asking is that when 40 or 50 of you drop that information, the rest of the audience can scroll and see that the woman in Pennsylvania is in the same situation as the man in Arizona, and the retired teacher in Ohio is one step ahead of the retired engineer in Texas. And you stop feeling alone in this. You start feeling like a battalion. Drop the field report. I will see it. Now I'm going to walk you through the 5 forms. These are the 5 documents that need to be filed, signed, recorded, or updated before your spouse passes. Not after. Before. There are equivalent moves you can make after a spouse dies, but most of them are weaker, more expensive, more limited, and time-pressured under grief. Doing this work before is roughly 5 times more powerful than doing it after. So get these in front of your spouse, sit at the kitchen table on a Saturday morning with coffee, and work through the list. Form 1 is the updated beneficiary designation on every single retirement account, life insurance policy, and brokerage transfer on death registration that you both own. This is the simplest, cheapest, and most overlooked move in American estate planning. It costs $0. It takes about 40 minutes per account. You log into the Custodian, Fidelity, or Vanguard, or Schwab, or TIAA, or whoever holds the account. You click on the Beneficiary tab, and you update 3 things: primary beneficiary, contingent beneficiary, and, if the custodian allows it, per stirpes designation, which is a Latin legal term that means if a beneficiary dies before you, their share goes to their children, not back into the pot. Robert in our opening scene died with the IRA beneficiary line saying, "Review." That single piece of paper not being updated cost Linda's kids roughly $170,000 over 10 years. 40 minutes of work. Listen to me carefully. If your spouse has a 401k from a former employer they retired from in 2008, that 401k probably still lists the beneficiary they named in 2008. Check it. The retirement plan administrator does not call you to remind you. Form 2 is the transfer on death deed for the house, or its functional cousin, depending on what state you are in. In Florida, Texas, Michigan, West Virginia, and Vermont, there is a special instrument called a ladybird deed, also known as an enhanced life estate deed, which lets you retain full control of the house during your lifetime, including the right to sell it or mortgage it without anyone else's consent, but automatically transfers the house to your named beneficiaries at the moment of your death, bypassing probate entirely. In Ohio, Pennsylvania, Arizona, Colorado, and roughly 30 other states, there is a transfer on death deed, sometimes called a TOD deed, or a beneficiary deed, which accomplishes the same goal through a different legal mechanism, You record this deed in the county recorder's office. You pay a recording fee of typically $25 to $75, and the house transfers outside probate. No court, no attorney fees, no 3 to 7% of gross estate, no public file. The deed is the difference between Sarah and Michael getting the house in 30 days or getting the house in 22 months. Record it before either spouse dies. After the first spouse dies, the surviving spouse can record a new one, but doing it together while both spouses are alive avoids any later argument about competency or undue influence. Form 3 is the revocable living trust, properly funded. I want to spend a moment on the phrase properly funded because most of you who already have a trust have an unfunded trust, and an unfunded trust is a piece of paper in a drawer. A trust only protects the assets that have actually been retitled into the name of the trust. So if you signed a revocable living trust in 2009 and you never went back and retitled the house deed, the bank accounts, the brokerage accounts, into the trust does nothing when you die. The assets still go through probate. The attorney who drafted the trust in 2009 was supposed to give you a funding letter and a checklist. If you have a trust and you cannot remember whether your house is titled in the trust's name, walk into the county recorder's office in your county and pull your own deed. Or look it up online if your county has an online portal and check whose name is on it. If it says your name and your spouse's name, the house is not in the trust. If it says the John and Linda Smith Family Revocable Trust dated March 14th, 2009, the house is in the trust. There is no third option. Properly funded, revocable living trust handles avoidance of probate, succession of trustee in event of incapacity, and orderly distribution to beneficiaries. It is the single most powerful estate planning document for a middle-class American household, with a paid-off home and a retirement account stack. Form 4 is the durable power of attorney with healthcare directive and HIPAA authorization. All three signed and notarized and stored where the kids can find them. This is the form that operates while you are alive but incapacitated, which is statistically a much longer window of vulnerability than the window between death and funeral. The durable power of attorney empowers your name agent, usually the surviving spouse, and a successor agent, usually one of your adult children, to handle financial matters when you cannot. Pay the property tax, sign the Medicare paperwork, cash the Social Security check, sell a security in your brokerage account to cover a hospital bill. The healthcare directive, also called a living will or advance directive, tells the hospital what you want done if you cannot communicate. The HIPAA authorization, which is a separate form most people forget, allows your designated agent to actually receive medical information from the hospital under federal privacy law. Without the HIPAA form, the hospital will refuse to talk to your daughter in Denver because she is not on the form. Without the durable power of attorney, your spouse cannot sell the rental property to cover the long-term care bill. Without the healthcare directive, the hospital makes decisions you would not have wanted. All three forms, executed together, witnessed and notarized according to your state's requirements, kept in a fireproof safe with the location, communicated to 2 of your adult children. Form 5 is IRS, Form 706, the United States Estate and Generation Skipping Transfer Tax Return, with the portability election explicitly checked on page 2. Now I know what you are thinking. You are thinking, John, our estate is not anywhere near the $15 million federal exemption. Why would I file an estate tax return when I do not owe any estate tax? And here's the answer. Because filing Form 706, even when no tax is owed, is how you preserve your deceased spouse's unused exclusion amount, the DSUA, for the surviving spouse to use later. This is portability. It was made permanent by the American Taxpayer Relief Act of 2012. The election has to be made affirmatively. The IRS does not assume you want it. If your spouse dies with $14 million of unused exemption, and you do not file Form 706 to capture it, that exemption is gone forever. Now you might say, John, I will never have $14 million of estate, so what do I care? You care because, first, the federal exemption is scheduled for various potential adjustments over the coming political cycles. Second, life insurance death benefits count toward estate value and can push you over surprisingly fast. Third, your house appreciates and your IRA grows. And fourth, If Congress ever drops the exemption back to the $5 million range that some proposals have floated, you are going to wish your spouse's DSUE was sitting in your file. Form 706 is due 9 months after death, with a 6-month extension available, and the IRS does have a simplified procedure under Revenue Procedure 2022-32 that allows certain estates that did not file timely to file up to 5 years later, but you should not rely on that. File the form. Those are the 5. Now let me show you the math with 2 versions of the same scenario, because move 5 in the John Warns You playbook is the side-by-side, and side-by-side is where the lights come on. Carol and her husband Daniel, both 71, suburban Cincinnati, Ohio, paid off home $385,000. Combined IRAs, $720,000. Daniel's 401 AK rollover, $310,000. Joint brokerage, $180,000. Term life on Daniel, $250,000, with the original 1996 beneficiary still listed, who is Daniel's brother who passed in 2017. Total gross estate north of $1.8 million. Scenario A. Carol and Daniel do nothing. The 5 forms are not filed. Daniel dies in March 2026 from a sudden stroke. The IRA beneficiary on Daniel's accounts is, like Robert's, listed as Review or as the original 1991 designation. The life insurance pays into the estate because the named beneficiary is dead. The deed is joint tenants. Half steps up, half does not. There is no trust. There is no Form 706 filed because the family CPA tells Carol she does not need to, since they are under the federal exemption. There is no transfer on death deed. Run the leakage. Probate fees on the brokerage and the life insurance proceeds, somewhere in the $20,000 to $35,000 range. Lost step-up on half the house, leading to roughly $35,000 to $50,000 of capital gain tax when Carol or the kids sell. Forced 10-year distribution of Daniel's portion of the IRA if Carol mishandles the rollover, costing the kids somewhere in the $80,000 to $130,000 range in additional income taxes. Lost DSUE portability, which costs roughly nothing immediately, but eliminates flexibility for any future estate growth or law change. Total leakage in Scenario A is somewhere in the range of $135,000 to $215,000. Scenario B, Carol and Daniel sit at the kitchen table in November 2025. They file the 5 forms. Updated beneficiaries on every account with Carol as primary and the kids per stirpes as contingent. Transfer on death deed recorded at the Hamilton County Recorder's Office, costing $42. Revocable living trust drafted by a local estate planning attorney for $2,800. Properly funded with the house, the brokerage, and the after-tax accounts. Durable power of attorney, healthcare directive, and HYPE AA authorization, signed and stored. When Daniel dies in March 2026, Carol files Form 706 within 9 months, makes the portability election, captures roughly $14 million of DSUE. Run the math. Probate fees, 0. The house transferred via TOD deed. The trust handles brokerage and after-tax. The IRA rolled cleanly to Carol because the beneficiary line was correct. The life insurance paid to Carol directly because the beneficiary was updated. Lost step-up problem partially mitigated because the trust handled basis correctly. Total leakage in Scenario B, somewhere in the range of $4,000 to $9,000, mostly attorney and recording fees, and the small step-up gap on community property-style assets. The difference between Scenario A and Scenario B is approximately $130,000 to $210,000. On the same estate, same starting balance, same date of death. The only difference is 5 forms. The clock ticking on those forms is the clock between Daniel's heart attack and the actuarial table. Pull out your phone. I mean it. Pull it out, hit the share icon, and send this video. Send it to one person. I want you to picture the one specific person in your life who needs to see this. The widow at your church who refuses to talk about her late husband's paperwork because it is morbid. The retired teacher next door who keeps saying, "I'll deal with the will next year." The brother-in-law you do not really like, but you respect his marriage and you know his wife is the one who handles their bills. The neighbor whose paid-off house is twice as old as yours, and who has never opened a manila folder marked house in his life. One person. Today, not next week. Today. Because here's the thing. If you watch this video and you take the 5 forms seriously and you act on them, you have done a good thing for your family. If you watch this video and you also send it to one friend who acts on it, you have done a good thing for 2 families. One share is the difference between $130,000 staying in a family or being absorbed by the federal government. One conversation now saves them $75,000 to $200,000 later. That is the math. Send the video. Save the spouse. Now let me do the regional rule of 3, because the 5 forms behave slightly differently depending on what state you live in, and I do not want anyone watching this in Florida applying the rules from Ohio. Florida. No state income tax, no state estate tax. Homestead exemption that is among the strongest in the country, with constitutional protection of the primary residence from most creditor claims under Article 10, Section 4 of the Florida Constitution. Florida is also one of the 5 states that recognizes the Lady Bird deed, which is the enhanced life estate deed. And Florida is one of the strongest states in the country for elder asset protection if you set things up correctly. But Florida also has a Medicaid estate recovery program under the Agency for Healthcare Administration that will chase the homestead in some circumstances after the surviving spouse dies, particularly if the home is held in the wrong type of trust. In Florida, the play is Lady Bird deed, plus revocable living trust, plus updated beneficiaries, plus durable power of attorney, plus Form 706 portability election. The Lady Bird deed is doing the heavy lifting on probate avoidance for the house. The trust handles the brokerage, the beneficiaries handle the retirement accounts. If you are in Sarasota, Orlando, Jacksonville, the Villages, anywhere in Florida, this is your stack. Ohio, modest state income tax. No state estate tax since 2013, when Ohio repealed its state estate tax, which was a real win for retirees in Akron, Columbus, Cincinnati, Cleveland, Toledo, Dayton, the entire state. Ohio recognizes the transfer on death deed under Ohio Revised Code. Chapter 5302, sometimes called a transfer on death affidavit, which is the Ohio equivalent of the Lady Bird deed. It is recorded at the county recorder's office in the county where the property sits, which means Hamilton County for Cincinnati, Cuyahoga County for Cleveland, Franklin County for Columbus, Summit County for Akron. The recording fee runs in the $35 to $60 range depending on the county. The trust is still useful in Ohio, particularly for the brokerage and after-tax accounts, but the TOD affidavit is doing the work on the house. Ohio also has aggressive Medicaid estate recovery, which is one reason that getting the house out of the probate estate via a TOD deed matters more in Ohio than in some other states. If you are in Ohio, this is your stack. California. High state income tax. No state estate tax, although California has explored state estate taxes in several legislative sessions in recent years, and the conversation has not gone away. California recognizes the transfer on death deed under the California Revenue and Taxation Code, but with a number of restrictions and disclosures that make it more cumbersome than the Florida or Ohio versions. In California, the revocable living trust is the primary instrument, more than in any other state I follow, because California probate is famously slow, expensive, and fee-heavy, with statutory probate fees that scale aggressively with the size of the estate. On a $1.2 million estate in California, the statutory probate fee schedule can produce attorney and executor fees in the range of $46,000 to $50,000 combined, before any court costs, before any creditor claims, before anything else. The trust eliminates that. In California, the stack is heavy on the trust, lighter on the TOD deed, with the 5 forms still required across the board. If you are in California, sit down with an estate planning attorney this month. Not this year, this month. The cost of the attorney is roughly $3,000 to $5,000 for a basic plan, and will save your family roughly $50,000 of probate friction on a typical home plus IRA estate. 3 states, 3 different stacks, same 5 forms. The forms are universal. The order and emphasis shift depending on where you live. Let me close this out because I respect your time and you have been with me for half an hour and I owe you a clean exit. There is no version of this where waiting helps you. None. Every month you do not file these forms is a month where the math gets worse. The house appreciates further, the IRA grows further, and the gap between scenario A and scenario B widens. Every month is also a month where your spouse's health is one day older, your spouse's memory is one day older, and the window for clean execution of these documents, while both spouses are competent and lucid, is one day narrower. There are cases I have watched, real cases, where a husband had a mild cognitive event in October, and by January, he could not sign a power of attorney without his daughter filing for guardianship in probate court, a process that costs $4,000 to $9,000 and takes 3 to 6 months and produces a public record. The window is narrower than you think. The IRS is patient. The IRS is waiting. The IRS has built a trap, and there is no version of the trap that softens, because you are a nice person who paid your taxes for 40 years. The system does not know that. The system reads the file. If the file has Form 706 filed and the portability election checked, and the beneficiaries updated, and the deed recorded, and the trust funded, the system processes the estate cleanly and your children get what you spent 45 years building. If the file is missing any of those pieces, the system extracts the friction tax, slowly, document by document, and the friction tax pays for a small part of the federal budget. That is the deal. Save this video right now. Hit save. Add it to your private library. Bookmark it on your phone. This is your survival manual for the conversation you need to have with your spouse this weekend. Then hit like, because the algorithm needs the signal to push it to one more family. Then hit subscribe and the bell, because there are 11 more videos in this series, and the next one is on the property tax exemption that 60% of qualified retirees in Florida and Texas and Arizona never claim, and you do not want to miss that one. Then drop your field report in the comments, state and age and beneficiary status. Then pull out your phone and send this to one friend, the widow, the retired teacher, the neighbor with the paid-off house, one person, today. Then sit down with your spouse this weekend at the kitchen table with 2 cups of coffee and the manila folder marked House IRAS Insurance, and you go through the 5 forms. Updated beneficiary designations on every account. Transfer on death deed for the house. Revocable living trust, properly funded. Durable power of attorney with healthcare directive and high pay authorization. Form 706, ready for filing in the event one of you dies. Call an estate planning attorney on Monday morning, not a generic estate attorney. An estate planning attorney who handles middle-class families with paid-off homes and retirement accounts. Pay the $2,800 to $4,500 for the package. It is the single highest return on investment dollar you will spend in your 60s. Linda in Sarasota is still sitting at the kitchen table. She's going to figure most of it out eventually because Michael and Sarah love her and they have a CPA friend in Charlotte who is going to walk her through Form 706 before the 9-month window closes. Linda is going to lose roughly $90,000 to $130,000 of friction that she would not have lost if Robert had sat down with her in 2022 and done the 5 forms. That money is gone. The casseroles stopped coming 3 weeks ago. The dog has stopped walking to the back door. The phone calls from the church have slowed to a trickle. The manila folder is open on the kitchen table. Do not be Linda. Be Carol. Be the version of yourself that sat at the kitchen table in November and filed the forms while both spouses were healthy and lucid and the coffee was still hot. The system designed this trap 40 years ago, and Congress has refused to fix it through 6 administrations and a dozen tax bills. And the Joint Committee on Taxation has scored the revenue from your inaction and built it into the federal budget. That is the truth. You know it now. Most of the country does not. Most of the country is going to find out the same way Linda found out on a Tuesday morning in late January with a manila folder and a cold coffee. You have the chance to find out tonight while the spouse is still in the next room watching the news and to act on it tomorrow morning before the second cup. Stay sharp, stay angry, stay liquid. The 5-form trap was built for the retiree who does not know it exists. You know now. Go act like